The CNBC app. Global market news in one place. Customizable sections and personalized alerts. Stocks tracking, interactive charts and market insights all in your hands. Stay connected. Stay informed. Download the CNBC app today.
Welcome to Squawk Box. Here are your headlines today. UBS beats on the top and bottom line, posting a second quarter net profit of $1.1 billion, with the Swiss lender's Global Wealth Management unit seeing $27 billion in net new assets. We'll be hearing from the UBS CEO Sergio Motti in an hour's time. Japan's Fumio Kishida steps down as Prime Minister, ending a 3-year term next month, with the country now set for its third Prime Minister in 4 years.
U.S. majors rally as investors raise bets on a 50 basis point Fed cut next month after PPI comes in softer than expected. Attention now turns to today's U.S. CPI print. And the U.S. Department of Justice reportedly considers pushing to break up Google after a court finds the company has an illegal search monopoly.
We've got numbers crossing from UBS this morning, so let's get into the detail here. And the first line on the second quarter profit before tax, $1.47 billion versus $982 million seen in consensus. So it is a beat on that second quarter profit before tax number. When it comes to the second quarter revenue, $11.9 billion versus $11.55 billion seen in consensus. Again, topping out on the revenue print. The company is saying it is expecting higher market volatility compared to the first half. And what we've, of course, seen on markets has been a lot of volatility. The second quarter profit before tax, the $1.5 billion, just to repeat that line. In terms of what we heard from the company, it has said today in its media release that the numbers today are reflecting client franchise strength and disciplined strategy of their execution of that strategy and integration plans. And of course, we're talking about the integration of Credit Suisse. In terms of the Global Wealth Management division, and this is key as we take a look at the underlying business, continued client momentum, net new assets of $27 billion US. They're talking about strong transactional activity in the investment bank, best second quarter for global markets revenues on record, and underlying global banking revenues up 55% year over year. They're saying significantly outperforming the fee pools across all products. The company, in terms of risk-weighted assets, non-core legacy risk-weighted assets, they have been reduced by 42% since the second quarter of 23. That includes an $8 billion decline quarter over quarter from active unwinds. So again, taking down that risk, underlying operating expenses, ex-litigation declined 17%. Additional gross cost savings of $0.9 billion US, so reaching about 45% of the total cumulative annualized gross cost saving ambition. So there's a lot here, maintaining balance sheet for all seasons, strong CET1 capital ratio of 14.9%. Again, that's important as we talk about the strength of the bank. Let's get to Beat Wittmann, Chairman Porter Advisors, and Beat is someone who's weighed in a lot over the course of time around UBS and Credit Suisse. So Beat, thank you very much for joining us on the earnings release today. First blush, what did you think of the numbers?
Well, good morning. It's a good and solid set of figures and also news along expectations, no doubt. UBS benefited, of course, from two factors mainly. The backdrop, the macro backdrop in the first half of the year was very positive in capital markets. And the second thing is, of course, that's coming down to UBS leadership. They executed really on the integration of Credit Suisse, of course, and also pursuing their medium-term business plan and priorities from a very strong global position, particularly in wealth management. So all fine. And then, of course, that's positive for the stock price. Short term, no doubt, meeting expectations, beating expectations. But then, of course, the challenges are then a different set of topics in the second half of the year and then beyond.
Viet, we know that UBS does not operate in a bubble, and we've had a lot of events playing out. Number one, what happens with interest rates? They said in the release they have been offsetting anticipated net interest income headwinds. And of course, we're now talking about central banks cutting rates from here. The other point is on the institutional activity, where they benefited in the latest quarter, especially strong institutional client activity, transactional activity. What changes in the next half, given we've had somewhat of a market event in recent weeks and we're all reshaping our thought process around central bank policy?
Well, the macro backdrop in terms of global growth, interest rates and inflation rates is, of course, in transition. Looking into the second half of the year and also into 25, we are facing a global synchronized downturn led by the US, of course, and yield curves normalizing again. So a bit a less favorable environment for banks in general. But, that's a normal cyclical downturn. And the central banks have elevated interest rate levels to levels where they have plenty of room to ease due to a slowdown, or in the case of any kind of defaults or other casualties or event risks in the markets. And, banks are well equipped to deal with this type of environment. It's a normal cyclical downturn. And then on the other side, of course, UBS, being a very strongly global leading wealth manager, can benefit from, the more difficult environment in geopolitics. There is growing demand for safe haven assets. We see it in the Swiss franc, and then also for safe haven, high quality counterparts. So I would not be surprised to see ongoing strong figures in terms of assets under management in the institutional business, and particularly in the private wealth business in the second half of the year and then next year. So UBS in that sense is well positioned, and the challenges are all the same for all the banking players.
Yeah, it's very interesting how that this company is really just trudging along and really doing well, actually, considering the context as well. They also make note of how it's enabled them, the execution of the next critical phase in the migration of unlocking further costs, capital funding and tax benefits. Speaking about that merger, how important was it to show that the integration process here of Credit Suisse is moving speedily ahead? How important was it for this entity?
It's absolutely key. And I think the leadership is highly aware of it, and therefore has really pushed hard to accelerate on the integration. And I think they're absolutely right to do this. And then we have also to be realistic. The stock price expects this. Basically, investors expect flawless execution. If there would be some non-delivery on such key initiatives in the topic of integration, that would not be very beneficial for the stock price, of course, and for the leadership. So they have to be flawlessly executing this integration. They know that, and they do it. And so far they have delivered. And I have basically no doubts that this will be on the existing trajectory. And the leadership is delivering on the integration plan and also on the positioning of the bank. However, the big challenge, and I think that's the key factor and the key driver, whether UBS can medium term really close up to global peers, especially in the US in terms of valuations and performance, is really the Swiss regulatory and supervisory framework, which needs to apply lessons learned from the Credit Suisse collapse that was entirely predictable and entirely self-inflicted. It cannot be that Swiss authorities again are unprepared, getting unprepared in such a situation again. And next time, of course, should UBS have a problem, there is no other Swiss bank because they are the only one left. So therefore, it's very important to have the focus on the results of the Parliamentary Commission of Inquiry and the respective recommendations for adjustments in the regulatory framework to lift it up to a global playing field of New York, London, and Frankfurt. And there will be a lot of political discussions this fall about additional capital requirements and other measures to make sure that UBS is a safe counterpart in a Swiss regulatory framework.
Yeah, I mean, that regulatory framework, very important as well. And you've always offered a sort of a frank assessment, especially to these Swiss regulators as well. Then what reforms are you actually suggesting as well? If you were part of that regulatory conversation, what is it that you would perhaps be suggesting here? Because you've created ultimately another bank that might be another case of too big to fail.
Well, there are three elements. One is the central bank, one is the Swiss Finance Ministry, and then the supervisor authority, FINMA. Leading to the Swiss Credit Suisse collapse, of course, it became clear that the coordination between the three entities was less than optimal, really, having led to that infamous weekend of this merger and acquisition by UBS, and basically there needs to be a discussion about better coordination and also better resources in terms of personnel, in terms of enforcement of existing laws, and most importantly, because it's a globally systemically important bank, the coordination with the main counterparts in New York, in Frankfurt, and in London. Because yes, there is an important Swiss business at UBS, but it's a global player and has relevance in New York, in Frankfurt, in London, and for the capital market at large. So it's very important to have a level playing field, really. And the solution cannot be a Swiss finish, which is in discussion, because UBS and the Swiss Financial Center need to be able to compete with the same rules and regulations and capital requirements like all other players. But that's only possible if the Swiss policy framework is up to the standards in terms of resources, in terms of transparency and accountability to the international other centers.
Beat, thank you so much for joining us on The Back of Numbers today. Beat Wittmann with us, Chairman Porter Advisors. Just a quick look at the stock price over the course of the year. It's not done very much, so we're closely watching the stock price today. You can see it is actually trading down a fraction so far this year. It did come off the boil with other market players this past week or so as we saw the market event, and it hasn't recaptured all of that territory. So we'll be hearing more from the UBS CEO, Sergio Motti, at 8 o'clock CET.
Now, Japanese Prime Minister Fumio Kishida is stepping down, saying he will not run for re-election as the leader of his ruling Liberal Democratic Party. Kishida's approval ratings have dropped amid a political funding scandal which has plagued his party and concerns around Japan's economy, including a volatile yen and the country's highest inflation in more than 3 decades. Let's head on over to Lynn, who joins us then from Singapore with more. Lynn, how significant a move is this?
Good morning to you, Arabile. Of course, this is very significant because it means that in September we will have a new leader. We will have a new Prime Minister of Japan. But in terms of the reaction from the Japanese public, also from Japan watchers, you could potentially characterize it as shocked but not surprised, because Fumio Kishida's polling and his sort of polling numbers have been absolutely abysmal. The latest numbers in June showing that there was only about a 10% approval rating in his favour. We spoke to a few analysts during Asia programming. For example, Japan political analyst William Pesek. He described this as Japan's Joe Biden moment, that ultimately the writing was on the wall for Fumio Kishida, that he wasn't going to win this leadership race that was coming up in September. So in terms of what he said at the press conference about 2.5 hours ago, he said that, that he said this was the best decision for the public, that he was taking responsibility, particularly as you were just raising there, the fallout from the slash fund scandal that engulfed the country back in November. And he's hoping that this will basically mean that there's a fresh slate here for the country and for the leadership. And on the economy, he said that it it was his administration that was able to provide this key achievement of laying the groundwork for the country to get out of full deflation. But that's really interesting because, again, in terms of some of the analysts that we've been speaking to, their view is that while the political slush fund scandal was a key component here, that perhaps the biggest reason was in terms of the economy. Of course, Japan has been after inflation for about 2 decades now. They are getting that inflation, but it's not the good kind of inflation, the demand-driven inflation. And as you were highlighting there, particularly this year, Japan has seen a massive influx of inbound tourists, but the yen has been so weak, it has gone as weak as 160 against the dollar, which means that purchasing power for everyday Japanese and households have been diminishing, and really real wages, even though the wage growth is coming back up, hasn't kept up with the inflation, although that data seems to be changing in terms of the latest numbers. But these are some of the major concerns that the Japanese public are grappling with. And when we look at the market reaction in terms of the last 2.5 hours since the decision came out that he would be stepping down, it's been, pretty mixed. Like, markets are still trying to kind of work it out, I think, and digest this news. You had the Nikkei 225 trending higher, but then falling back behind the flat line. And I think the key question going forward will be who will be his successor, who will throw their hat in the ring in terms of that LDP leadership election in September. They will all be coming from the ruling party, of course, but that will be the key thing to watch for markets. Back to you.
Yeah, Lynn, thank you so much for that. I think it's definitely very interesting how things continue to shift along as well in Japan. We'll continue coverage of that story as well. Then Lynn joining us on that one. Now, coming up on the show, U.S. producer price inflation comes in softly in July. The latest data point suggesting the Fed will be ready to cut rates come September's big meeting. But now, attention turns to today's CPI print. That will be very important. Plus, a stir at the top of Starbucks. CEO Laxman Narasimhan has replaced then by Chipotle chief, that's Brian Niccol. We'll discuss later this hour. And UBS second quarter net profit comes in at just over $1 billion. We'll bring you Sylvia's interview with Sergio Emotti. That's at 8 a.m. CET.
CNBC Connect is back in Bangkok, Thailand. Join the world's top entrepreneurs and C-suite executives for an invite-only leadership retreat. On the agenda, powering innovation and growth in Asia. Is AI transforming industries and creating opportunities? And get insights on building sustainable and resilient businesses. Be part of Managing Asia Live. Network and join an interactive brainstorm session. CNBC Connect, powering innovation and growth in Asia on September 4. Register now.
Now, U.S. producer price inflation rose less than expected in July at 0.1%. It's on the month, with the core reading coming in flat. That's half what analysts had penciled in, and puts the yearly inflation figure then at 2.2%. That's way down from June's 2.7% reading. But Atlanta Fed President Raphael Bostic said he wants to see a little more data before he's ready to support lowering interest rates. Now, traders have been certain for more time now that the Fed will cut rates at its next meeting, with bets on a 50 basis point move once again ticking higher in the aftermath of last week's volatility. That's according to CME's Fed Watch tool. So what happened to the market then yesterday on the back of that PPI print? Well, we saw a rally, really a significant one here, as you see the Nasdaq then managing to gain 2.4%. Again, those tech shares being key proponents of that surge higher. 3% up actually in terms of sectors was the tech shares. The laggard was the energy stocks, then me actually being the only ones to have actually gone down 1% in yesterday's trade. You even saw the benchmark then S&P 500 going up 1.7%, nearly 90 points gained. They're headed towards 5,500 there, then nearly 40,000 points. Then again for the Dow Jones Industrial, 1% higher. In fact, all three majors now are pretty much in and around or above actually their closing level on August the 2nd. Of course, that session before the global market sell-off that we saw was majorly significant. It's been a quick turnaround really when one looks at this US market picture. Today, however, will be that US CPI print that the market will be focusing on. July expectations are pointing toward a 0.2% rise on the month-on-month basis for both the core as well as the headline figure. I suppose any miss on that number will be very key to this and may even interpret to a lot more volatility in this market play. But what do the treasuries then have to say to all of this? Well, yesterday we saw them dip after that PPI print came out then yesterday, signaling potential Fed easing coming through in September. And as we pointed towards, it could be even as much as 50 basis points that the market is actually anticipating there. The 10-year yield falling 3 basis points yesterday to 3.87, now even at 3.84 in fact, so significantly lower there, and still firmly below that 4% mark as well then for the 2-year Treasury note, then around 10 basis points worth the difference between the two. And finally then on to the dollar crosses here. The currency, particularly the dollar, is a little bit on the back foot actually in today's trade, but as you can tell, mostly around the flat line. Yesterday sterling actually had one of its better performances. In fact, according to the numbers, its best one-day performance versus the dollar since late April, and is sitting near a 2-week high there, nearly 129 in fact at some stage as well. So very interesting numbers to look out for there. The currency rallying after a boost from data as well yesterday, surprising to the upside there, seeing UK jobless rate surprisingly drop as well. Karen.
Arabile, let's move on to all things tech. Already having a terrific conversation with Arjun around the set. The US Justice Department is reportedly considering a breakup of one of the biggest names on the planet, Google. That's according to Bloomberg and the Wall Street Journal. It comes after the tech giant was found to have violated antitrust laws by illegally maintaining a monopoly in internet search. Department of Justice Assistant Attorney General Jonathan Cantor told CNBC that protecting competition is particularly important as AI becomes mainstream.
As we sit here at the next technological inflection point, it's extremely important that we protect the competitive process to make sure that the benefits of innovation, the excitement that we're all feeling from AI and from these new technological developments relating to machine learning, can reach consumers in a full-throated competitive way.
The FTC says the monopoly verdict against Google should be a relief to other app developers, and that any antitrust remedy may need to go beyond injunctions that target and enjoy specific exclusionary conduct in order to restore competition in digital platform markets. The agency made its statement as a Californian court considers remedies after a jury found in favor of Epic Games in its antitrust suit against Google. Now, Google unveiled a swath of new products at its annual Made by Google event on Tuesday, with Gemini AI taking center stage. The tech giant also launched new versions of its Pixel phone, watch and earbuds. Arjun and I were talking initially off camera about some of this regulatory probe and the monopolistic verdict, but I think what we've seen overnight from this Pixel launch has been incredible advances on hardware. My initial take was it's going after Apple business, but you had a slightly different take as well.
Yeah, I think there's always going to be those in sort of the Apple world who will think about a different phone, but actually this is a bigger threat really to Android players. If you're an Android user, Samsung, Motorola, some other device, you already know the operating system. You can transfer over all your sort of Google apps, your account onto a Pixel phone, and so I think that's where it poses the biggest threat. Some of the reviews I've read, particularly around the Fold device, have been very, very stellar, saying it's a huge upgrade from what Google has put out before, makes the previous Fold from Google look like a prototype, one of the reviews said, and provides perhaps real competition to Samsung's Galaxy Fold products at this point as well. So it's a big launch in the hardware, but look, the biggest deal really from the launch was what Google was talking about with Gemini, with AI.
And they've wedged a lot of Gemini into the products, and I think for anyone who's used AI search engines, you can see they're quite different to the search engine we've been using, which is the same search engine that regulators are now taking issue with and saying, should Google be forced to split up its business? One of the remedies, put Chrome on one side, Android on the other, or stop some of these big default deals where they're paying out the likes of Apple to be the default engine. As we take a look at this Pixel development, how key is the advance here? And what sort of behaviour could we see in terms of it reinforcing or entrenching this monopolistic position that Google has?
Yeah, well, the huge thing, I think, with Google is the hardware business has never been massive. It's not been a huge scale play for Google. They've always brought out product to show what you can do with the best of Android and the best of Google software.
Similar to Microsoft in some
Similar
ways?
to Microsoft and what it does with Surface as well. And so what Google is doing here is saying, look, we've got great phones, yes, but if you use and design devices that are able to run Gemini and Android to its fullest capabilities, here's all the things you can do. There are some incredible things around the photo editing tools where you could sort of add a person into a group photo if they're missing. You could also do text to image generation, some of that generative AI through Gemini as well. And remember, for Google, they have billions of Android devices out there. It doesn't matter what the manufacturer, running Google software. And now they've of course launched a Gemini Advanced, a $20 a month subscription service. And so this is all about, I think, driving revenue, monetizing that AI, and driving revenue to some of that subscription as well through all of those people around the world who are using Android and wanting to pay for some of the more advanced parts of Gemini.
To me, there's an issue here because you want a holistic approach to AI because you want to lock down the security aspect. So end-to-end user experience, quite key. But this is exactly the issue that regulators will be fighting against.
This is it. And their biggest concern really is about the dominance Google has in search, and that then translating into the world of AI, given all that data that they have at the moment. And so if there's any kind of major behavioral changes required by the regulators on Google, that's going to have the biggest impact. But if there's sort of some of the changes we've seen so far, perhaps in the European Union, it may not be as big a deal for Google. So it really is going to be the detail really of what the FTC says after this.
Thank you for listening to Squawk Box Europe Express.
For more market-moving news, you can head to CNBC.com.
Or join us again on the show with Steve Sedgwick, Karen Cho, and myself, Arabile Kumete, weekdays on CNBC.